Ladies and gentlemen, good day and welcome to Kanpur Plastipack Limited Q1 FY26 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then zero on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Mamta Samat from Adfactor PR. Thank you, and over to you, Ms. Samat.
Thank you, Renju. Good afternoon, everyone, and welcome to the Q1 FY26 earnings call of Kanpur Plastipack Limited. Today we have with us Mr. Manoj Agarwal, Chairman cum Managing Director, and Mr. Shashank Agarwal, Deputy Managing Director. We will begin the call with the opening remarks from the management, after which we will have the forum open for the interactive Q&A session. I must remind you that this conference call may include forward-looking statements about the company, which are based on the beliefs, opinions, and expectations of the company as on date of this call. The statements are not the guarantee of future performance and involve risks and uncertainties that are difficult to predict. I now hand over the conference to Mr. Manoj Agarwal, Chairman cum Managing Director of Kanpur Plastipack Limited, for opening remarks. Thank you, and over to you, sir.
Thank you, Mamta ji. Good afternoon, everyone. I'm delighted to welcome you all to Kanpur Plastipack's maiden earnings call for the first quarter of financial year 26. Thank you for joining us today. As this is our first call, I would like to share a brief on our company. With over 5 decades of experience in industrial packaging, Kanpur Plastipack is among India's leading manufacturers and exporters of flexible intermediate bulk containers, FIBCs for short, PP multifilament yarn, woven sacks, and a variety of value-added fabrics. Our in-house production capabilities from yarn to finished FIBCs allows us to maintain stringent quality control, ensures cost efficiency, and scale up operations quickly. Over the years, we have transformed from a regional woven sack manufacturer into a fully integrated, globally competitive packaging solutions provider. Established in 1971, our company has consistently focused on capacity expansion, technology upgrades, and process automation to strengthen its market position. Our manufacturing facilities house state-of-the-art equipment like extrusion tape lines, circular weaving machines, lamination, ultrasonic cutting machines, and sewing lines with in-house testing laboratories and recycling plants. We are a certified food-grade facility with an A+ rating from British Retail Consortium, the gold standard for such certifications. Backward integration by including the production of PP multifilament yarn, UV master batches, crimped yarn, has ensured consistent quality, offering us the flexibility to meet diverse customer requirements across global markets. Our journey reflects a commitment to innovation, quality, and sustainability. We have expanded its footprint internationally, exporting to over 40 countries and delivering customized packaging solutions that meet the demands of a dynamic global market. Today, it stands as a trusted partner for industries worldwide, combining decades of experience with a forward-looking approach to growth and excellence. Our loyal customer base is well diversified across sectors such as food, agriculture, chemicals, mining, and construction, with no single client contributing more than 5% of the total revenue. Exports account for nearly 70% of our business, enabling us to maintain stability and resilience across market cycles while continuing to pursue sustainable growth. Coming to our Q1 financial year 26 performance, our total income from operations grew 34% year-on-year to 182.24 crores. EBITDA rose 119% to 15.5 crores, and net profit stood at 6.91 crores versus a loss in the same quarter last year. The growth was driven by healthy demand in our core FIBC business and woven packaging segments, higher value-added product sales, and operational efficiency gains. The appreciation of the US dollar also provided a tailwind to our export margins. From a strategic perspective, this quarter marked a significant milestone with the acquisition of a 76.19% stake in a UK-based Valex Ventures Limited for a value of rupees 8.02 crores. The acquisition gives us direct access to premium food grade and UN certified FIBC customers in the UK, enhances our developed market presence, and opens a gateway to the EU market under the recently signed UK-India Free Trade Agreement. We have successfully raised 20.50 crores through the preferential issue of 17,60,000 warrants, which has been utilized to repay the debts, and second preferential issue of 13.15 crores for 10,12,000 warrants is underway. This will help us to reduce debt and further strengthen our balance sheet. Our credit rating was upgraded to CRISIL BBB+ stable for long-term facilities and to CRISIL A2 for short-term facilities, highlighting our strong financial risk profile. Our way forward focuses on driving growth in high-margin, scalable segments like FIBCs and value-added fabrics. We are undertaking a debottlenecking exercise with small investments in stitching, storage, and warehousing, laying emphasis on enhancing operational efficiency, automation, and improved risk management. The vacated facility at our CPP division will also be utilized for this purpose. The emphasis will continue to be on margin expansion by higher realizations, cost control, and improved product mix, building a stronger balance sheet for diversification and reducing interest costs to better financial efficiency. At this point, I would like to hand over to our Deputy Managing Director, Mr. Shashank Agarwal, to walk you through the detailed financial and operational highlights for the quarter. Thank you very much.
So thank you. Good afternoon, everyone. In terms of performance, Q1 FY26 was a strong quarter across all key metrics. Total income from continuing operations stood at 182.24 crores, 146.72 crores coming from manufacturing and the rest from trading, up by 34%, 11% in manufacturing and 23% in trading, from 136.28 crores last year. EBITDA increased to 15.54 crores, with margins improving to 8.51% from 5.20%. Net profit came in at 6.9 crores compared to a loss of 1.16 crores in the same period last year. EPS for the quarter was 3.01 rupees. Breaking down further, FIBCs continued to lead our product mix, supported by repeat orders from long-standing customers across Europe, America, and Asia. Multi-filament yarn sales were supported by growing demand from both internal use and external textile customers. Fabric sales, including circular, sulzer, and ventilated types, gained traction in agricultural and industrial packaging applications. In Q1 FY26, the product revenue mix stood at 182 crores, out of which the manufacturing was about 146.72 crores, where FIBC contributed the largest share at 51%, about 74.82 crores. Fabric accounted for 31.36%, which was 46.01 crores, while other products formed 6.22%, and multi-filament, which is MFI, brought about 9.65%. The small works contributed 1.77%. This mix underscores the company's strong reliance on FIBC, supported by significant contributions from fabrics and other product lines. From a geographical perspective, in Q1 FY26, for manufacturing sales, exports accounted for nearly 74% of all the revenue, and the domestic was about 26%. Within the 74% revenue, Europe remained our largest market and our stronghold at 48.75%, followed by South America at 30.44% and North America only contributing to 18.31%. We could see emerging traction in Japan and Brazil. The continent-wise mix continues to give us balanced exposure to both developed and emerging markets. Operationally, we are focused on efficiency and scalability. This year, we have engaged Grant Thornton under Risk and Advisory to help us enhance process efficiency, plug revenue leakages and identify automation opportunities. We are also currently working on debottlenecking in stitching, storage warehousing to increase throughput and reduce turnaround times. Sustainability remains a key pillar of our business. 47% of energy needs are currently met through solar power, and our proposed target is to reach 60%. Our facility maintains zero liquid discharge and are fully EPR compliant, and all our products are designed to be fully recyclable. The combination of operational discipline, market expansion, and sustainability focus positions well for continued growth. The operational excellence initiatives are currently underway, and we are contributing to cost reduction efforts. With a strong order book, healthy demand outlook, disciplined execution, and loyal relationships with our clients, we are confident that Kanpur Plastipack is on track to deliver consistent, profitable, and sustainable growth in the quarters ahead. We now welcome and look forward to your questions. Thank you.
Thank you. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. The first question comes from the line of Deepika Bandare, an individual investor. Please go ahead.
Thank you for taking my question. And congratulations on the good set of numbers, sir. So my question was regarding margin. Is this 8.53% EBITDA margin sustainable in the coming quarter?
Yes. So thank you, Deepika ji. So the margin is sustainable considering the depreciated rupee, stable raw material, ocean freight, and increased manufacturing. Because the manufacturing in the developed world has gone up after the Ukraine-Russian crisis, because the gas prices have stabilized. There is also an identified shortage of good workforce globally, which is making our customers come back to us again and again. So with the combination of consistent demand, depreciated rupee, stable raw material, and ocean freight, we do not see any challenges there.
Okay. So
So the sustainable margin will remain between 9 to 10%.
Okay, so it will be in 9 to 10% range.
Yeah.
Yeah, and my second question was on the acquisition side, the acquisition of Valix. What all synergies you see in the coming year, and how it will contribute to our margins and revenue?
Yeah. So there were a couple of things about Valix. So Valix was actually owned by the promoters themselves. So it was also from a corporate governance standpoint that it had to get merged back into Kanpur Plastipack at some point. And because the origin of Valix was under crisis when it got started, it was only doing about £500,000 worth of revenue before. But this year we did 1.1 million, and now it will continuously increase by about 5 to 10% every year. So we have based out reaching to end users, giving them design guidance, and our experience in that is helping the business grow.
Understood. And what are the margins we are making on that company?
So on a GM level, it is about 25%. And the UK-India FTA will help this acquisition, and it will help the profitability there. The top line, I mean, ultimately for Kanpur Plastipack, the net increase in the top line would be about 4 to 5 crores on a consolidated way. And the contributions will come immediately as it's a going concern, and it's an acquisition of a going concern.
Okay. Understood, sir. Thank you.
Thank you. Next question comes from the line of Saket Kapoor with Kapoor and Company. Please go ahead.
Namaskar, Agarwalji, and thank you for this opportunity. Sir, firstly, pertaining to this UK acquisition only, this was a promoter entity only, sir, if I heard you correctly. Can you explain then the nature of the transaction? And we have only acquired, I think, so closer to 76%. So what happened to the remaining stake? And if you could just explain.
Namaskar, Kapoor Sahab. Good to see you again. Good to hear you again, rather. And so the company was held by the Valex Ventures was held by the promoters itself, and they only held 76% because there was a local partner who held 24%, and he continues to hold that. He is the driver of the business. He has over 5 decades of experience in textiles and packaging. So that was the nature of the transaction. So it was all share buyout.
Okay. So what was the sales, what was the last year sales? And how have we valued the company? For our 24% stake, it is at 8 crore. So around 10-11 crore is the total value of.
That's correct. 10.5 crores is the valuation of the company. And the last year's sales was 1.1 million. This year we are expecting it to be between 1.2 to 1.3 million. It follows the same financial year. So this year's expectation is around 1.2 to 1.3.
So you mentioned about 4 to 5 crore. So if we speak in Indian rupee, ज़्यादा sir easy समझ में आएगा. So 5 crore is what will be the top line for this year, and the profitability. Yeah, yes sir.
So on a consolidated way, because Kanpur Plastipack sells to Valex Ventures, so only the additional GM that is there will get added to the top line, and so that's why I said that the net addition that will happen is only 4 to 5 crores.
Thank you. Mr. Kapoor, please rejoin the queue for more questions. The next question comes from the line of Vaibhav P. with Honesty and Integrity Investment. Please go ahead.
Yeah. Hi, sir. Thanks for providing the opportunity. So, sir, good that you started the Concall. So that's a good initiative. I have a lot of questions, but I will just ask 3 of them and then leave the queue for the rest participants. So first, sir, if we see, lot of FIBC units are located near ports, while our unit is relatively at a larger distance from the port. But despite of that, we have good export business all across the globe. So what is the offsetting factor in our case, which is offsetting, higher domestic freight cost for us?
So I'll answer this and then you can ask the next question. Is that okay?
Yeah.
So you are absolutely right in this, but this also comes to an interesting corollary where Kanpur Plastipack is also the only unit that has survived 5 decades despite being away from the port. And so there are 3 primary reasons why the cost gets offset. One is that the availability of raw material, which is polymer, now has become North India. That is in Panipat, Bhatinda, and now Barmer, which used to be originally near Hazira and Jamnagar.
Okay.
Second is that there is a reverse logistics cycle that's there between Kanpur and Mundra, where the cost of goods from Kanpur to Mundra is not substantially higher compared to, let's say, Ahmedabad to Mundra, because the reverse logistics cost is much higher. There is far more import than exports into Uttar Pradesh.
Got it.
And third, which is the most important one, is the labor arbitrage. Most of the factories that are operating in the south or in the west, as you pointed out, people come from Uttar Pradesh or Bihar. And Uttar Pradesh still remains to be the largest state in the country with a population of 25 crores and also the highest younger workforce that's available to work in factories. So we are able to get people to train much quicker and faster and retain them.
Got it. Yes, I think that's a very good answer. So secondly, on food grade FIBC, so if you can help us understand what is the total capacity of food grade FIBC that we have and the sales that we did last year? I'm not talking about the quarter, but maybe last 2 year figure, FY24 and FY25. What is the capacity and sales of FIBC, and what is the margin difference between food grade FIBC and other FIBC products? And secondly, on FIBC, food grade FIBC itself, is our capacity between food grade FIBC and non-food grade FIBC fungible, or it's like, we have dedicated capacity for both of them separately?
So your question suggests that you understand the industry very well. So I will try to give a very brief and a very quick answer on this. The entire capacity that is there is food grade. So it is interchangeable. 100% of it is interchangeable. So,
Got it.
but that does not define the real capacity. The real capacity is actually defined by the skilled workforce that is available to work on this, which is about 75% of the total capacity. Having said that, we as a company do not want to cross the 60% threshold level because it has its own challenges in terms of the sustainability and the risk factors that are involved with it. So last year, out of the total FIBC sale, we were around 40% that was in food grade and chemicals, which is also as complex as food grade. So I consider them as both. In terms of profit margins, we consider them in the similar range. So 40% was food grade and chemicals. This year, it will be around 50%. In the next couple of years, it will continue to go from 50 to 55, 55 to 60. The difference of the margin that is there between standard product and food grade product is substantially high. So one could be around 12% EBITDA, the other could be around 7% EBITDA.
Interesting.
But our remaining 40% that is there, right? So if 60%, so let's say 55% is food grade, the remaining 45% that's there, only 15% of it would be at 7%, which is the building and pure mineral sector. The remaining comes under agro and complex textiles. So this is where the EBITDA could be between 9 to 10%. That will remain at 30%. That is still already.
Got it. And then lastly, this will be the last question, and then I will come back in the queue. So we already have FIBC and some other, multi-filament yarn business, and also, but do we plan to enter into any other new PP-based products? Like, there are companies who are doing geotextile, there are companies doing pond liners. So are we planning to enter into those products, or as of now, there's no such plan?
So specifically about pond liners, we have no plans. We believe that it's a business of building a future liability because there are guarantees and warranties that are required in that product. So we will not enter that market segment. On geotextiles, we are already present, and we did about 2,000 tons. So that's about 40 crores last year in geotextiles. This year it would be closer to 60. And the next year that it's planned, it would be between 60 to 80 crores. So that is an area that we are continuously expanding in.
So this other that you classify as other products, these are mostly geotextile, is it?
Yes.
In your presence. Okay.
Some of it comes under fabrics and some of it comes under others.
Okay.
I think we will make a better classification next time.
Got it. So yeah, I will come back in the queue. I have many more questions, but I will come back in the queue now. Thank you very much.
Thank you. Next question comes from the line of Praveen Sharma, an individual investor. Please go ahead.
Hello. Am I audible?
Yes, absolutely.
Yeah. Good afternoon, Manoj ji and Shashank ji, and congratulations for the fantastic turnaround in the company, and congratulations on starting this Concall. It takes us into next orbit of corporate governance and transparency, and I hope everybody will like it. So my first question is, we had this, I've been a very long-term investor in the company for almost 10, 15 years, and I have witnessed many cycles. Now, this kind of turnaround, what I have seen in this year, it's quite amazing. And when I see results of other companies in the similar sector, they have also done decently well, if not as good as ours. So I just wanted to know, what is the reason for the sudden buoyancy in FIBC sector in India in general? Is there any tectonic shift or demand shifting from other countries to ours? This is my first question, and I'll ask next few more questions subsequently.
So, Praveenji, thank you for coming on the call and thank you for your long-term trust in the company. So I'll just break down into two parts. So first is the tectonic shift that you're talking about. So yes, as China and Far East continue to enhance their manufacturing capabilities into electronics and pharma and other products, their focus on labor-intensive manufacturing goes down. And then the only other alternative that's there today is in India. India also is currently very well positioned in the geopolitical system and in the diplomatic relations across the world at the moment with the right policies for manufacturing in India. That has also helped us. There is no discounting of the fact that almost 0.9% of the EBITDA is because of the rupee depreciation that happened. We have also seen a significant stability in the raw material and the ocean freights over the last 12 months. And I would again reiterate my point that I said in my opening statement that there is a thrust on global manufacturing and global agriculture that is absolutely improving packaging needs. And that is requiring packaging needs. As we become more sustainable, people are looking at wastages and efficiencies in a very, very different way. Nobody wants to waste agro produce. People would first have their wheat in open tractors and open trucks. Now they want packaging, even in Africa. So emerging markets are also significantly increasing their demand for these kind of products. I hope I was able to answer the question.
Mr. Weber, please go ahead. Since there is no reply from the line of Mr. Weber, we'll move to the next. The next comes from the line of Mr. Aniket, an individual investor. Please go ahead.
Hello. Hello.
Yes, Aniket, I can hear you.
Yeah. So, sir, I have few questions. Sir, based on this Valex acquisition, so it will remain independent or how is going to work in future?
So it is an independent company. It will remain an independent company with independent management, but it will be backed up by Kanpur Plastipack in terms of technology, in terms of design resources, in terms of customer advice, technical support, and also the supply chain.
Okay, got it. And sir, as we are seeing the sharp turnaround in our EBITDA PAT, so it's just because of this acquisition?
The acquisition, so it has not happened yet. The acquisition results will start coming in from the next quarter. This is because of the tailwind that's there, because of the increased demand, better operational efficiency, better capacity utilization, better margins that are there.
Okay. And sir, related to this, so in terms of the raw material prices, so as we see, are you seeing any impact of the crude oil fluctuation prices on the polypropylene in the near term?
So more or less, polymer and crude oil have become delinked now because the supply chain of polymer and the supply chain of crude remains independent of each other, the supply-demand gap as well. So we have seen a very high level of stability, and rather the polymer has actually reduced in the last couple of months.
So, sir, based on that, can you give some...
Sorry, in terms of dollar terms. I'm talking about dollar terms. Yeah.
Okay. So, sir, can you give some guidance for FY26 and 7? How do you see the trend in future, and how are we going to get the benefit from it?
So as I said, that EBITDA numbers in terms of percentages are more or less supposed to remain the same going forward. This quarter also looks good. The demand is there. The order book is good. The next couple of quarters, the next 3 quarters, the demand will be there. So we look at similar EBITDA numbers.
Thank you. Mr. Aniket, please rejoin the queue for more questions. Next question comes on the line of Weber B with Honesty and Integrity Investment. Please go ahead.
Yeah. Hi, sir. Thanks for providing the follow-up opportunity. In terms of our PP fabric business, in FIBC, there is high labor component, which makes India very competitive. But in fabric, I think the labor component is much less as compared to FIBC. So what makes you and you competitive in fabric market, which enabled export of this product?
So I think you've hit the nail in terms of understanding the business. So FIBCs is the more complex product. The more FIBC we do, the more profitable we will be. So from now on, this quarter onwards, you will see that there is a shift, that the percentage of FIBC sale will continue to increase as a total percentage of the manufactured product. Fabric will continue to shrink. This will take a couple of years, and that is the reason we are investing in manufacturing capacity of FIBCs. This is the first part. And now answering your question, why people buy from us for fabrics, where it's only a commodity and it's cost competitive. So we have built a very strong brand reputation in countries in East Europe and in South America, which is about consistency, quality, and reliability of delivery. Because this acts like a raw material for them to produce more bags. So it needs to be consistent in quality and delivery both. And there are very few people who are able to do that. So we command a premium because of that. And that is the markets that we continue to serve.
Got it. But we had some challenges in Brazil business, if I'm not wrong, and there was no local fabric there, and then there was a nuclear setup capacity in Brazil, and our exports suffered. So my question was in that context, that what is changing in this business as such, and why other countries are also becoming competitive.
So again, in the specific case of Brazil, the Brazilian real has not depreciated as much as the Indian rupee. So what it has done is that it has made our product more competitive despite having the tariff barriers that are there. When there was a problem in Brazil, their agricultural produce for that 12 months had gone down. And also there was surplus production capacity of fabric in that country at that moment. In the last 2 years, there is more demand that has come up because of better agricultural produce in Brazil itself and the need of packaging of that agricultural produce. Finally, the biggest problem that they are facing at the moment, because of which they are wanting to buy from us, is that they do not have enough people to work in factories to make fabric and bags.
Thank you. Mr. Weber, please rejoin the queue for more questions. Next question comes from the line of Praveen Sharma, an individual investor. Please go ahead.
Yeah, thank you for taking my question again. Shashankji, in the annual report, first of all, congratulations for penetrating the Japan market. You mentioned in the annual report, it is mentioned in your address that the market has a potential of $500 million, which is around 4,000 crore or something. And given the stickiness which Japanese customers have with their vendors, is it possible that we may get at least 10% of this potential market, say $50 million in next 2 to 3 years?
So, sir, you hit the nail again with the stickiness that they have, right? So we, as a company, have been very, very conservative in our approach towards Japan, and it is like an approach of slow and steady wins the race, like a marathon. We are entering very, very slowly, and we will continue to enter very, very slowly. The big shift from Japan to India will happen whenever there is a structural change in Chinese manufacturing capability and capacity. So today, China is only 5 days from Japan, but India is about 30 days from Japan. This is something that we will not be able to overcome very quickly. Whenever this structural change will happen, either the shipping reduces or the Japanese or the Chinese factories do not have enough people to work on FIBCs, then this will happen, and that is the time we want to be absolutely penetrated in the market and capable in the market to capture the 10% that you're talking about. But to say that this will happen in the next 2-3 years, I think it is a very, very, very uphill task. I think we are talking about 1% market share, 0.5% market share, 1.5% market share in the next 1 or 2 years at the moment. We don't look at very, very big numbers because we want to go very, very slow and steady and be like partners together.
Okay, best wishes. On UK market with the FTA in offering, how do you see business panning out there? Do we see what is the potential there, and do we see a significant market capturing happening there by us? And my last question is on the Trump tariff in North America, impact of that.
So, about UK first, so I think the FTA is a brilliant move. It will not only enhance the margins that are there, but it will also increase the demand itself, because UK itself will become competitive in many other things. So it will have increased manufacturing. Once it has increased manufacturing, it will have increased demand. So with increased demand, there will be more volume, and definitely there will be a little bit of margin improvement that is there, because India was facing stiff competition in UK from Bangladesh and Vietnam. About the additional tariffs that have been applied by the US government on India, so 10% became 25%, and then there was an additional 25% because of the Russian oil. So it is very hard to predict what will happen, but as far as the company goes, our 18% turnover is in North America, out of which about 14% is in US and 4% is in Canada. So it is not a very significant volume that is getting affected. There are no orders on hold. There are no order cancellations. I think there is a wait and watch scenario that's going on. There is extreme volatility in decision making, which is beyond our control or beyond the control of the importer. It is not a product that can be shifted overnight. So we continue to receive orders. Even last week we received orders from US despite this 50% addition. So I think people are hoping, and there is a higher probability that this 25% Russian oil additional tariff will go away.
Thank you. Mr. Sharma, please rejoin the queue for more questions. Next question comes on the line of Ashish Vanjari, an individual investor. Please go ahead.
So thanks for the opportunity. So my question is, while CRISIL has maintained a stable outlook, are there any potential risks, like such as raw materials? Hello?
Yeah, I'm just requesting the chairman and managing director to respond to that, please.
Can you come back again on that rating? I didn't get a question, please.
Yeah, I'll come back again. So while CRISIL has maintained a stable outlook, are there any potential risks such as the raw material prices, forex exposure, or demand fluctuations that could impact the rating going forward? And how does the management plan to mitigate that risk?
Yeah, so the stable is a category. It's a category BBB plus is the main rating category that CRISIL is given. We were earlier a triple B minus, so it's an upgrade. That's one part of the answer. Risks, of course, in every business enterprise, we have risks. There'll be raw material fluctuations, there'll be forex fluctuations. But we have a well-defined policy to handle, for example, I'll take your three risk perspectives. One is raw material. Raw material, the DMD just mentioned, has been very stable over the last year. Is handled closely at the top management level. We have a buying policy. We have a buying policy, and there's a process in place which ensures that we are hedged for the raw material also when the orders come in. Forex, we have a well-defined forex management policy. I happen to handle that personally directly with my CFO on that. But in the global uncertainty situation that we lie in today, I have to frankly admit that forex will always remain a risk. It is how best you can handle it. I wouldn't say that it is not a risk. Yeah?
Okay. Actually, I have another question also.
Yeah.
With the fundraise, with the recent fundraise and the planned debt reduction, could you share the current net debt position and the timeline by which the company expects to become net debt free?
Yeah. So last year, FY ending, we were having about a term loan of 80 crores and a working capital loan of 120 crores. So we had 190 crore rupees of outstanding debt. By end of this year, we should be in a position of having about 15 crores of long-term debt and about 110 crores of working capital limit. So that is about 125 crores. So from 190, we will be down to 125.
Thank you. Mr. Manjari, please rejoin the queue for more questions. Next question comes from the line of Saket Kapoor with Kapoor and Company. Please go ahead.
Yes, sir. Just to come to the last point about the debt part, we mentioned somewhere about being net debt free with the capital raising exercise done. So can you explain, sir, where is that gap in my understanding?
Sorry, could you repeat your question, please?
Sir, we were of the opinion that with the fundraising exercise and with the CPP unit divestment, we would be net debt free. That was our understanding, my understanding. Yeah.
Correct. So this 14 crore rupees is an outstanding term loan which will be repaid over the next couple of years. And on a gross block of 200 crores, 14 crore rupees is really not any long-term debt. And 7 crores out of that is GCL, which was given during the COVID period, which will get repaid anyways in the next year.
Okay. So, but with this acquisition, the UK one, wherein the fund, actually the fund is, the hand changing is only between the company and the promoter entity. So will this be further infused back in the form of this preferential allotment only? This money is going to come back to the company. This is how the route will.
No, it's a share exchange, right? So there is no fund flow in this. It's a swap of shares.
Okay, swap of shares. So can you explain a bit? We are acquiring 76%, so the shares will be issued in favor of Kanpur from one promoter to Kanpur Plastic. That is how the transaction will be consummated.
Correct. The promoter will get shares of Kanpur Plastipack, and he will renounce shares of Valix Ventures in lieu of that. And that will make Kanpur Plastipack the owner of Valix Ventures.
Okay. Sir, only small point about the margin improvement. I think so you were mentioning about some debottlenecking exercise and then FIBC having the highest revenue share going ahead. So for this year, what are we looking? I think so 33% is what we did in FIBC for the first quarter. My first question, how is this going to increase by the end of this quarter? And then, sir, in terms of this quarter revenue, we saw a higher percentage in the purchase of stock in trade also. So how should we look forward for the remaining 3 quarters in terms of the revenue trajectory and how the margins will be shaping up? I think so you commented earlier on this aspect also.
Yeah, but let me just re-clarify it again. So 182 crores was the total revenue, out of which 35 crore rupees was stock in trade. This came out of an opportunity during the period, and this keeps on coming. With more liquidity that's available with us, we are able to do this. There is a small margin that we make on this stock in trade. It's a trading of the raw material that we consume, which is polymer. Out of the 146 crore rupees of manufacturing, 51% came from FIBCs, that is about 75 crores. This as a percentage will continue to rise over the next quarters. Fabric was about 46 crores and other products and multi-filament and small bags put together was about 26-27 crores, which is about 16.5-17%.
Thank you.
Yeah.
Go ahead.
No, that's all.
Thank you. Mr. Kapoor, please rejoin the queue for more questions. Next question comes from the line of Sagar Shah, an individual investor. Please go ahead.
Hello. Am I audible? Hello.
Yes, you are audible.
Yeah. Thank you. Thank you for the opportunity, sir. Just wanted to understand, is it possible for you to give a product-wise bifurcation, that is in terms of the margin? So FIBC, how we are doing in terms of margin in MFI and all those products?
Yeah. So FIBC remains to be the highest margin product. Fabric and multi-filament is at a similar margin, which is about half of FIBC. And small bags has no significant margin, and that's why you see that its revenue share is also only 1.5%.
Okay. And sir, when we say we are into FI, that filament yarn, so any plan that company has to venture into technical yarn going ahead, more grade of technical yarn?
No, there are no current plans to venture out into technical yarns at the moment.
Okay, sir. And sir, last question on this guidance perspective. So what is your guidance for financial year 26 as far as top line and bottom line is concerned?
So the order book is good. Demand is robust. Operations excellence continues to keep our costs under control. EBITDA will be in line with the first quarter. The benefits will start coming from the next year of the increased capacity addition in FIBC. So we are currently working on a very detailed strategy for the next 5 years for other and newer products that we might add to our existing portfolio. The FIBC last year we did about 285 crores. This will remain our main focus, and by 2028 we would like to do between 425 and 450 crores.
Okay, thank you. And last one on this manufacturing facility. So, what is the current capacity utilization of all the manufacturing plant?
So when we see it as a whole,
Average.
our capacity. Yeah, so as a whole, when we see the capacity utilization for the last financial year was about 75%. The last quarter was also between 75 and 77%, depending on how we calculate it, because this was also the period of harvesting season, monsoon, and the peak of Lu that happens in North India. The Andhi chalti hai, it's called Lu.
Okay.
But if we specifically talk about FIBC as a capacity utilization, we are currently installing more capacity, and the capacity from fabric will continue to interchange into FIBC as we go along.
Okay, so current capacity of FIBC will increase to how much?
So we are currently running around 1350 tons per month. This will go up to 1800 tons per month.
And what is the expected timeline for this?
This will take about 1 to 2 years.
Okay. And the capacity expansion will be done by how? Internal accruals or?
Yes, it will be done by internal accruals. The land is already in place. The machines are under installation, and a building is also being made.
Okay. Thank you. That's it from my end.
Thank you. Next question comes from the line of Weber B with Honesty and Integrity Investment. Please go ahead.
Yeah. Hi, sir. Thanks for providing the opportunity again. So, sir, two questions. One is on the U.S. business. As you said, you briefly explained the tariff impact, but are we seeing pricing pressure from the U.S. customers? Are they trying to shift some of the tariff burden to us, and maybe margins in that business might suffer because of this tariff issue? Is it happening, or they are just completely taking all the tariff burden on themselves?
Honestly, it's very early to say. Right now, we have not faced any pressure because the order book is already good at the moment. If this stays on, then there will definitely be pricing pressure. But if it goes away, then it will not be there.
Got it. Because, even 25% is too much. Even if Russia tariff goes away, even if it's going to be
10 was already there. So 10 became 25.
Yeah.
So,
Okay.
I mean, to put the answer into perspective, if the only 25% remains, then we do not see that there will be any demand glut or a shift from India. There could be slight margin pressure initially, but we will not see demand go away.
Got it. And sir, secondly, on the role of distributors in this business, obviously because they are more customer facing, they ultimately supply to customers. So who decides the pricing to the end customer? Is it like distributors? They decide which company's product has to go to the ultimate customer at which prices. How does this whole dynamics work? Between a distributor and the ultimate consumer?
So most of the distributors that we have more than a decade relationship with them. So it is extremely transparent between our margins and their margins. And let me put it in this way, that 70% of the pricing is decided in a transparent manner, which is tender-based, high-volume business, old business, repeat business. 30% of a business, which is new business or first-time quotation business, FTB, first-time business, there we give a fixed margin, then they add their margin, and then they quote to the customer.
Got it. So, see, my point was, I was trying to understand that, ultimately from customer's perspective, who is the most price competitive for a given quality? That's what matters. Quality we control, but if price distributors control, then how can we increase market share? That's what I was trying to.
80% of the business is repeat business. So there the pricing is already established. It is only the remaining 20% business that needs to be increased every year, where the pricing needs to get established. So yes, there.
When you say pricing is established, do you mean to say that we, with ultimate customer, we decide the price with ultimate customer and distributors just backward calculate their margin, and so we have the control on price to the ultimate customer?
There are two different things. One is pricing power, and the other is the pricing decision. Right. So once a relationship is established between the end customer, distributor, and the manufacturer, then the pricing power is out of question, because then it is on inflation, it is on dollar exchange rate, it is on freight, it is in polymer. So then that gets passed on. Now the decision of pricing is only to the first time buyer or a tender business. There, if it's a tender business, it's a joint decision between the distributor and the manufacturer. And where it's a first-time buyer, then we quote. Sometimes we are participating amongst multiple competition. Sometimes we are the only people who are participating because it's a complex bag and people are looking, and it's a high sensitivity bag in terms of quality and reliability. Then we would have the pricing pressure. Then we would have the pricing power.
Got it. Understand. That's it from us. Thank you.
Thank you. Next question comes to the line of Saket Kapoor with Kapoor and Company. Please go ahead.
Yes, sir. In the previous reply, sir, you were answering towards how the FIBC contribution would be increasing, and you did answer that how you are planning to increase the capacity. So the business profile for the first quarter there is a very likelihood that we will be improving upon on these numbers going ahead, since there was some impact of some weather disruption for the first quarter. This understanding is correct, that going ahead, the business profile with the improved order booking is more likely that we see the better set of numbers?
The entire focus of the company is on increasing the FIBC numbers. So on a medium to long-term basis, yes, the numbers will go up. It is very hard for me to give exact short-term picture on this.
Okay. So since you have engaged a third-party grant Thornton, which you have mentioned, so what are the kind of task or the milestone that you have set them to get into the systems in terms of increasing the operating margins, or what is the mandate given to them, sir? If you could just explain, and by the timeline by which they would be giving you the report and your implementation of the same.
So the project assigned to GT is to provide strategic recommendations, not only to mitigate risks, but also to streamline processes, enhance compliances, and drive improvements and productivity. So the timeline for this is the next 6 to 12 months. We will get the reports, execution will start happening, and it's an ongoing exercise. It's not a one-time transactional exercise that we've got into.
Okay, sir. That's all from my side. So just to look into it, because we have seen this up cycle at the time of COVID also, when if I'm not wrong, we did post good profit, but after that there was a big slump and the industry went into a downward spiral. So what is yours currently gives you the confidence that those sectors are not going to, God forbid, those sectors will repeat, and this track would be more sustainable in terms of the revenue business profile, and also in terms of the margin profile going ahead, sir?
So, I mean, of course, I cannot predict the future, but there are three significant differences that we see this time. One, there was definitely a pent-up demand at that time where people were building up inventory because of the fear of running out of material. That does not exist today because the shipping crisis does not exist. The lockdown crisis does not exist. Second, the manufacturing globally had reduced. Due to the Ukraine-Russia crisis, the gas prices went up so high that there was a complete halt of manufacturing in Western Europe. Thirdly, agriculture as a commodity has required an improved packaging, which is also driving demand. Because the focus on sustainability and wastage is extremely high now.
Sir, all point understood. Only point is, if and when the Ukraine crisis gets settled, how would that affect the FIBC industry? Since then there will be a normalization of trade. People who were there in the business will try to be back to the same business with lower energy cost flowing into the P&L. So what would lead? Yes, yeah.
So as far as the business goes, the Ukraine-Russian crisis was settled last year when the gas prices came down and when Europe started buying Russian gas again. Then so once those prices came down, the manufacturing went up again. So I mean, we are linked to logistics, warehousing, manufacturing, and agriculture produce. If these four segments have ripples, then we will have ripples as well.
Okay. Right, sir. So we can conclude this is a strong wicket on which we are continuing, forwarding any undue instance that may happen. Other than that, there's a very good visibility in terms of order booking, hence execution, hence improvement in margins. This we can summarize from today's conversation, sir, going ahead.
Absolutely.
Okay, sir. We will hope for the continuity of the calls, good presentation, and we hope for further participation and engagement with you, sir, going ahead.
Thank you. Thank you.
Thank you. Ladies and gentlemen, due to time constraints, we have reached the end of question and answer session. I would now like to hand the conference over to Shashank Agarwal for closing comments.
I think I would like to thank everybody who's there on the call to invest time in the company, and we will continue to do this after every quarter results. And we will be very transparent and continue to share everything that's available with us. Thank you once again.
Thank you. On behalf of Kanpur Plastipack Limited, that concludes this conference. Thank you for joining us. You may now disconnect your lines.
If you found this video helpful, please like, share and subscribe to Concall India for latest upcoming Concall.